Bitcoin is sitting right at $70,000. Inflation data just dropped, and the bill that could change crypto forever is still hanging by a thread in the Senate. Today is one of the most important days in the market this month. Let's break it all down.
Welcome back to Crypto Insight Hub. I'm glad you're here because if there was ever a day to stay plugged in, it's today. We've got a live CPI report rattling the market, a massive regulatory story that keeps evolving, Vitalik Buterin just dropped a bombshell about Ethereum staking, and the Fear and Greed Index is flashing extreme fear across the board. There is a lot to unpack, so let's get straight into it. Let's start with where the market is sitting today. The global crypto market cap is at approximately $2.46 trillion. That sounds like a lot, and it is, but the context matters. Yesterday, we were at $2.43 trillion, and last week, the sentiment was even more bleak. So yes, there is a mild recovery happening, but nobody is celebrating yet. Why? Because the Fear and Greed Index is sitting at 15. 15! For context, anything below 24 is classified as extreme fear. Last week, it was at 10, and last month, it was at 14. The needle is barely moving, and that tells us investors are still very much in survival mode, not expansion mode. Bitcoin is hovering just under $70,000 today. It hit an intraday high of $71,612 yesterday before pulling back. Ethereum is trading around $2,200, up about 1.78% over the last 24 hours. Solana is up roughly 0.35%. Ripple's XRP is up just over 0.5%. Even Dogecoin is having a solid day, up about 1.4%, which continues to be one of the stronger movers among the top coins today. On the losing side, DEXI is down over 8%, Filecoin is down about 8.2%, and Midnight is off by around 6.5%. So while the big coins are green, some of the mid-cap altcoins are still getting hit hard. Trading volume is at $125 billion today, up from $115 billion yesterday. More money moving around is actually a bullish signal. It suggests buyers and sellers are actively engaged rather than frozen on the sidelines. Rising volume during a recovery phase is something technicians watch very closely. One coin worth mentioning specifically is Pi Network. Pi is up roughly 8% today, continuing to attract attention from millions of users drawn to its mobile mining model. It's one of the most talked about tokens right now for a reason. Whether the fundamentals support that price action longer term is a different conversation, but the momentum is real today. Now let's talk about the elephant in the room, the CPI report. The U.S. Bureau of Labor Statistics released the February 2026 Consumer Price Index this morning at 8:30 Eastern Time. This was the most anticipated macro event of the week, and for good reason. Inflation data moves crypto markets, and it moves them fast. What were traders expecting going in? The consensus forecast was for headline CPI to come in at around 2.5% year-over-year, just a slight tick up from January's 2.4% reading. Core CPI, which strips out food and energy, was also expected to hold near 2.5%. Goldman Sachs, interestingly, was calling for a slightly cooler print, estimating core CPI closer to 2.42%. Now, why does this matter so much for crypto? Here's the simple version. The Federal Reserve uses inflation data to decide whether to raise, hold, or cut interest rates. Right now, the CME FedWatch tool shows about a 95% probability that the Fed holds rates steady at their March 18th meeting, which is just 1 week away. So the March cut is already off the table. But what traders are really watching is whether today's data shifts expectations for June or July. If inflation continues running hot, rate cuts get pushed further out. If inflation shows real signs of cooling, suddenly there's hope for summer easing, and markets can reprice accordingly. Here's the complicating factor that makes this CPI print especially tricky to interpret: the Iran conflict. On March 4th, U.S. forces conducted airstrikes on Iranian military facilities, and the conflict is now in its second week with no clear de-escalation in sight. Iran has threatened retaliation, the Strait of Hormuz has been destabilized, shipping giant Maersk has said it won't risk sending ships through the area, and oil prices have shot above $80 a barrel. That is a direct inflationary pressure, and it means even if today's February CPI looks manageable, next month's data could come in hotter simply because of oil. Bitcoin's response to this situation is interesting. Bitcoin fell from an intraday high near 71,000 yesterday to just under 70,000 this morning as traders went cautious ahead of the report. That pattern makes sense. In moments of macro uncertainty, money flows to the sidelines temporarily. When the data arrives, the algorithms react in seconds, and then human traders spend the next 30 minutes deciding whether that initial move was justified. The historical pattern here is also worth noting. When January's CPI came in at 2.4%, which was below the 2.5% consensus, Bitcoin rallied roughly 5% on that same day. So a cool print has the power to send Bitcoin back towards 72,000 and potentially higher. But a hot print? Analysts have flagged the 65 to 66,000 range as key support. Break that, and we could be looking at a test of 60,000.
This is a live story as of today, and the full market reaction is still unfolding as of this video. Watch the daily candle close carefully. That will tell you more about the real direction than the first 5 minutes of algo-driven volatility after the number dropped. All right. Now, let's talk about the story that might actually matter most for crypto's long-term future, the Clarity Act. The Digital Asset Market Clarity Act of 2025, commonly called the Clarity Act, passed the House of Representatives with a bipartisan vote of 294 to 134 back in July 2025. That was a huge deal. And as of today, March 11, 2026, the bill has passed the House but remains stalled in the Senate. So what does this bill actually do? At its core, it resolves something the crypto industry has been screaming about for over a decade. Nobody knows which regulator is in charge of what. The SEC claims most tokens are securities. The CFTC says Bitcoin and Ethereum are commodities. Neither drew a clear line. Instead of writing real rules, regulators just sued people. That approach has kept billions of dollars of institutional capital on the sidelines because big money doesn't walk into legal uncertainty. The Clarity Act draws 3 clear boxes. Digital commodities, think Bitcoin and Ethereum, go to the CFTC. Investment contract assets, which are tokens initially sold through investment contracts, start under the SEC. And permitted payment stablecoins get their own lane. Clean, clear, defined. For the first time ever, exchanges would know exactly which regulator to register with, custody rules would be spelled out, and the FTX-style disaster of commingling customer funds with corporate funds would be explicitly illegal.
Now, why is it stalled? Multiple reasons. The Senate Banking Committee and the Senate Agriculture Committee both have their own competing drafts. The Banking Committee advanced its version out of committee in January, but reconciling it with the Agriculture Committee draft before it goes to a full Senate vote is complicated. Then, in early 2026, Coinbase CEO Brian Armstrong polled his support, arguing the current text favored traditional banking institutions over crypto-native companies and would restrict features like stablecoin rewards. That withdrawal sent a shockwave through the industry and raised real fears that the legislative window could close before a deal was reached. But here's what's interesting. The bill has recovered momentum despite that opposition. Why? Because the coalition behind it is broader than any single company's preferences. JP Morgan analysts have said the bill's potential approval by mid-year could be a positive catalyst for the entire crypto market. Ripple CEO Brad Garlinghouse has signaled confidence that passage could be 90% likely by April. Kristen Smith, one of the bill's key advocates, believes it could pass by July. And perhaps most importantly, President Trump publicly warned on March 3rd that failure to pass the bill would drive the crypto industry to China. Treasury Secretary Bessent has also signaled a potential spring signing timeline if the Senate can get its act together. That's the highest-level executive pressure the bill has received, and it matters. For XRP holders specifically, the Clarity Act is enormous. Ripple has been fighting the SEC for years over whether XRP is a security. This bill could resolve that question permanently and in Ripple's favor. The same goes for Stellar, XLM, and the broader class of ISO 20022 compliant coins that are already woven into global financial messaging infrastructure. If regulatory clarity unlocks institutional flows into those assets, the price impact could be significant. The bear case is a prolonged delay. If the bill stays stuck in Senate negotiations into late 2026 or beyond, institutional capital stays cautious and prices stay range-bound, driven by macro factors rather than regulatory catalysts. That's not the end of the world, but it's a missed opportunity during a critical window. Bottom line, watch Washington closely over the next 6 to 8 weeks. The Clarity Act is the single most important piece of legislation for crypto markets right now, and its fate will shape the second half of 2026. Now let's shift gears to Ethereum, because Vitalik Buterin just said something that the staking community is still processing. On March 9th, Vitalik posted on X to reveal that the Ethereum Foundation used a simplified version of distributed validator technology, what he's calling DVT-lite, to stake 72,000 ETH. That stake is currently in the validator entry queue and is scheduled to go fully live around March 19th. This is not a proposal. The Ethereum Foundation already did it. So what is DVT-lite and why does it matter? Let's break it down. Traditional solo staking on Ethereum requires you to run a single machine as your validator. If that machine crashes, loses internet access, or gets hacked, you get penalized. It's called slashing, and it's painful. Because of this risk, most institutions don't want to run their own validators. They hand their ETH to centralized staking providers instead, which means staking becomes more concentrated, which is bad for decentralization. Full distributed validator technology solves this by splitting the validator key across multiple machines that coordinate together. But full DVT is complex, technically demanding, and frankly scary for non-experts to set up. That's where DVT-lite comes in. It's a simpler version. Multiple machines share the same validator key with a lightweight configuration. If one node goes down, another picks up immediately. Less complexity, less downtime risk, less need for specialist knowledge. Buterin's vision is explicit. He wants to make staking so accessible that an institution with large ETH reserves can set it up the same way they install software. One click. He even described the idea of pre-built Docker containers, where each participating machine enters the same key, the nodes automatically find each other, complete the setup, and start staking, all without a team of technical professionals. He was also blunt about his frustration with the current state of affairs. In his words, the idea that running infrastructure is this scary, complicated thing where each person participating must be a professional is awful and anti-decentralization. He said he plans to personally use DVT-lite himself. Here's why this matters for the market. Right now, about 37.5 million ETH is staked on the network, representing roughly 31% of the total supply. That's valued at approximately $76.5 billion. And yet, despite that enormous number, 3.2 million ETH is currently waiting in the validator entry queue, which is about a 55-day wait. Demand to stake is high. The bottleneck isn't interest, it's operational complexity. If DVT-lite makes institutional staking as easy as Buterin envisions, staking participation could realistically push above 40%.
More ETH locked in staking means less ETH in circulation, which strengthens the deflationary mechanics of the network. Combined with the Pectra upgrade that increases effective balances per validator and annual staking rewards already topping $2 billion, Ethereum's proof-of-stake system is becoming more compelling with every passing quarter.
The exit queue right now? Just 29,000 ETH with a 12-hour wait. People are not leaving staking, they're lining up to get in. That's a powerful signal about long-term confidence in Ethereum's network, even while its price is under pressure in the short term. We can't close today's video without flagging what's coming up next week, because it directly impacts everything we've talked about. The Federal Reserve's Federal Open Market Committee holds its March 2026 meeting on March 18th, just 1 week from now. And while today's CPI data was critical for setting the tone, the FOMC meeting will be where that tone translates into actual policy. The market has already priced in virtually no chance of a rate cut at this meeting, with inflation still running above the Fed's 2% target, and ongoing military conflict pushing oil prices higher, and sticky shelter inflation continuing to resist easy downward pressure. The Fed has very little room to ease right now. The dot plot that will be released alongside the decision will be closely watched for any signals about the pace of future cuts. For crypto, the relationship with Fed policy is well established at this point. High rates mean money flows to safer assets. Lower rates and looser financial conditions are rocket fuel for risk assets like crypto. That dynamic hasn't changed. What has changed is the complexity of the macro backdrop. War, trade pressures, sticky inflation, which makes predicting Fed moves harder than it was a year ago. The scenario most crypto traders are hoping for, today's CPI print comes in soft, the market rallies through the week, and the FOMC confirms in its statement that the data trajectory for summer rate cuts remains intact. That combination would be one of the most bullish setups the market has seen in months. Before we wrap up, let's quickly run through the broader altcoin picture, because there are a few names worth watching beyond the top 3. Pi Network is up around 8% today and continues to be one of the most talked about projects in the mobile mining space. Its unique approach of letting users mine directly from a smartphone has attracted millions of participants worldwide. The network has been working toward mainnet maturity for years, and today's price action reflects renewed interest from traders who believe the utility case is strengthening. Pudgy Penguins is also trending. The NFT-turned-token project has crossed 2 million physical units sold through its Phygital model, combining collectible toys with blockchain-backed digital ownership. It's an interesting example of a crypto project finding real-world product market fit, beyond just speculation. Starknet continues to get attention as a Layer 2 solution for Ethereum. While Layer 1 Ethereum itself is navigating the DVT-lite developments we covered, Layer 2 solutions like Starknet are doing the work of scaling the network at the execution layer, faster transactions, lower fees, and more throughput without sacrificing Ethereum's security guarantees. In DeFi specifically, the total market cap is sitting at around $51.6 billion today, with about $3.83 billion in trading volume. DeFi dominance is at 2.1% of the total crypto market. The sector is quietly recovering, and with potential regulatory clarity coming through the Clarity Act later this year, the long-term setup for DeFi may actually be improving even as short-term prices languish. On the stablecoin side, the combined stablecoin market cap is at $310.6 billion, with $95.4 billion in 24-hour trading volume. Stablecoins continue to serve as the liquidity backbone of the entire crypto ecosystem, and their growth reflects that more capital than ever is parked in the market ready to deploy. It's just waiting for the right catalyst. So let's take a step back and look at today's full picture. Bitcoin is at roughly $70,000, with the Fear and Greed Index screaming extreme fear at 15. The CPI report dropped this morning, and traders are watching how the market digests it heading into next week's FOMC meeting.
The Clarity Act is stalled in the Senate, but the political pressure to get it done is building by the day. Vitalik just showed the world that one-click institutional Ethereum staking isn't a dream. It's already being tested with 72,000 ETH. And across the altcoin space, there are pockets of real momentum and innovation, even while the broader market remains cautious. Here's the honest takeaway. This is a market in transition. The fundamentals are improving, regulatory clarity is closer than it's ever been, institutional infrastructure for Ethereum is getting better, and the Fed hiking cycle appears to be over even if cuts are delayed. But the fear is real. The macro backdrop is genuinely complicated, and nobody should be sizing positions based on hope alone. If you found this breakdown useful, drop a like, leave a comment with your take on today's CPI reaction, and subscribe if you haven't already. Crypto Insight Hub drops fresh analysis every single day, and on days like today, staying informed isn't optional, it's your edge. We'll see you tomorrow.